Picture something real, not a hypothetical, not a textbook example. A real American kitchen table somewhere in suburban Columbus, Ohio, on a Thursday morning in March of 2026. Her name is Carol. She is 71 years old. Her husband Dennis, the man she married at 24 in a small church outside Dayton, the man who worked 30 years on a manufacturing floor and never once complained about the early shifts, the man who still held her hand during movies even after 4 decades together, that man died 11 weeks ago. Pancreatic cancer. Diagnosed in August, gone by November. The garage still smells like him. The coffee maker still defaults to 2 cups every morning because neither one of them ever thought to change it. The dog still checks his side of the bed. Carol is sitting at that kitchen table right now. She has reading glasses on. She has a stack of mail she has been putting off opening. She has a yellow legal pad where she has been trying to write down questions she does not know how to ask. And she has a letter from her accountant that she has now read 7 times because she does not understand it. Cannot understand it. Refuses to understand it. Because what that letter is telling her, in the careful and polished language that accountants use when they are delivering news they do not want to be the one delivering, is that the federal government of the United States of America is about to pull approximately $68,000 more out of her retirement accounts this calendar year than it pulled out last year. Same accounts, same IRAs, same money that she and Dennis spent 38 years building together by doing everything right. They paid off the house. They maxed the 401k every single year. They drove the same cars until the wheels gave out. They never carried a credit card balance. They were the definition of the responsible American retirement couple. And now Dennis is gone, the household income actually went down, and the tax bill nearly quadrupled. Not tripled. Quadrupled. That is not a glitch. That is not a rounding error in the accountant's software. That is the United States federal tax code working exactly the way it was written to work the moment one spouse dies and the survivor picks up a pen to file a loan. There is a name for it. Financial planners who actually understand retirement tax planning call it the widow's penalty. And it is the single most financially devastating event that can happen to a middle-class American retirement, and almost nobody is talking about it until it is too late to do a single thing about it. I have sat across the table from surviving spouses who lost 6 figures to this trap. Good people, prepared people, people who had done everything right. And they lost that money not because they were careless, but because nobody ever walked them through 4 specific moves that would have legally and completely prevented it. 4 moves. That is the entire difference between Carol's situation and a surviving spouse who is financially protected. 4 asset repositioning strategies that live inside the same tax code that contains the trap. The escape hatch is in the same document as the guillotine. You just have to find the door before the blade drops. That is what the next 30 minutes is. We are going to walk through Carol's numbers so you understand exactly how the math works against the surviving spouse. We are going to name the 3 mechanical traps that stack on top of each other after a spouse dies. And then I am going to give you the 4 assets you must move before one of you passes and exactly how each move works. If this video makes you angry or scared or finally makes something click that your broker never explained, hit the like button right now. The algorithm pushes this video to more couples based on early engagement. There are people watching television tonight who need this information and will never find it unless this video reaches them. 1 tap. That is all it takes. Subscribe and flip the notification bell while you are at it, because this is the first video in a series and they build on each other. Now let us go back to Carol and Dennis and look at the actual numbers, because the size of what happened to her is something you need to see in writing to fully believe. In 2025, Carol and Dennis filed married filing jointly. Here is what their financial picture looked like. Dennis received a monthly Social Security check of $2,950. Carol received $1,750 a month. Combined Social Security income, $56,400 a year. Dennis had a pension from 30 years at a manufacturing company paying $22,000 a year with a 50% survivor benefit. They had a traditional IRA, mostly Dennis's old 401k rolled over when he retired, with a balance of $710,000. His required minimum distribution that year was about $27,000. They had a joint brokerage account at Fidelity worth $195,000, mostly low-cost index funds, generating about $5,500 in qualified dividends annually. And they had $90,000 sitting in CDs at their local bank paying around 4%, generating $3,600 in interest. Added up, $56,400 in Social Security, $22,000 pension, $27,000 RMD, $5,500 dividends, $3,600 interest. Total gross income as a married couple in 2025 was roughly $114,500. Now here is the beautiful part of being married that most people never fully appreciate until it disappears. As a married filing jointly couple, Carol and Dennis got the standard deduction of approximately $30,000. They got the additional over 65 deduction. They got the senior bonus deduction. Their taxable income dropped to around $75,000, and the 12% bracket for a married couple in 2026 stretches all the way up to nearly $97,000 of taxable income. So they paid 10% on the first chunk, 12% on most of the rest. Total federal tax bill around $8,200. Effective rate about 7% on $114,500 of gross income, 7%. On over $100,000 of income. That is the quiet gift the tax code gives to married couples that almost nobody talks about until it is gone. Dennis dies in February 2026. Carol is now a single filer for all of 2026. The IRS does not care that Dennis died in February. The IRS does not prorate the year. The IRS looks at your filing status on December 31st, and that is what you are for the entire year. There is technically a grace period called qualifying surviving spouse status that extends the married filing jointly rates for 2 years after a spouse dies. But it only applies if you have a dependent child living in your home. Carol's kids are 44 and 40. They have their own houses, their own mortgages, their own lives. Carol gets 0 grace period. She files single starting the year Dennis dies. Here is what Carol's income looks like in 2026. She loses Dennis's Social Security check. Household Social Security drops from $50,640 to $25,200. She keeps the survivor benefit from the pension, which was elected at 50%, so the $22,000 becomes $11,000. The IRA balance is now around $690,000. Her RMD as the surviving spouse who rolled the account into her own IRA is roughly $26,500. The brokerage still throws off $5,500 in dividends. The CDs still pay $3,600 in interest. Total gross income for 2026, $71,800. Carol's income dropped by over $42,000. She is significantly poorer than she was when Dennis was alive, and her tax bill is about to be 4 times higher. As a single filer, Carol's standard deduction is cut nearly in half, down to about $15,150. She still gets the senior deduction add-on for a single filer. She still gets the senior bonus. Her taxable income lands around $48,550. And here is exactly where the knife goes in. The 12% bracket for a single filer ends at roughly $48,475. Carol's taxable income is $48,550. She has crossed the 22% line by $75. Every dollar she earns above that line is taxed at 22% instead of 12%. That is not a rounding error. That is a 10 percentage point jump on every additional dollar of income. But we are not done. Because the bracket collapse is only trap number 1, and it is not even the most damaging one. Hey, quick pause right here. I want to ask you something genuinely. Have you and your spouse ever actually sat down and run this math? Not a rough estimate. Not a back-of-the-napkin guess. I mean actually modeled what your household tax picture looks like the day after one of you files a death certificate. If your answer is no, you are not alone. In my experience, almost nobody has done this before, the moment they absolutely have to. So go to the comments right now and tell me 2 things. What state you are in, and roughly how much is sitting in your traditional IRA or 401k combined. That is it. 2 pieces of information. I am going to use those comments to build follow-up content targeted at the exact situations people in this audience are actually facing. Drop it down there. I will see you in a minute. The widow's penalty is not one thing. It is 3 separate mechanical traps built into the federal tax code that fire sequentially after a spouse dies. Most financial advisors talk about the first trap. A few talk about the second. Almost nobody talks about the third one, which is the one that quietly drains the surviving spouse for the rest of her life without ever sending a single warning letter. Trap number 1 is the bracket collapse. We just walked through it with Carol. The 12% bracket for a married filing jointly couple is nearly double the width of the 12% bracket for a single filer. Look at the actual numbers. In 2026, the 12% bracket for a married couple runs from roughly $23,200 all the way up to nearly $97,000 of taxable income. That is about $74,000 of bracket width. For a single filer, the 12% bracket runs from about $11,600 to $48,475. That is $36,875 of width. The single filer's 12% bracket is roughly half the size of the married couple's bracket. The 22% bracket follows the same pattern. The 24% bracket follows the same pattern. The gap between married and single brackets exists at every level of the tax code. The entire architecture of the federal income tax system is built around the assumption that two people share income and deductions. The moment one of them dies, the survivor falls through a mathematical trapdoor in the floor. The income drops, but the brackets shrink faster. The effective tax rate goes up even as the gross income goes down. That is the bracket collapse. Trap number 2 is the RMD crossfire. This is the one that catches people who think they can simply spend less and avoid the problem. You cannot. Required minimum distributions do not care what you spend. They do not care that you are grieving. The IRS mandates that once you hit the required beginning date, you must withdraw a percentage of your traditional IRA balance every single year based on the Uniform Lifetime Table. At age 73, you are pulling roughly 3.8%. By 80, it is nearly 5%. By 85, it approaches 7%. The IRS forces the money into your taxable income whether you want it or not. And in the narrowed single filer bracket, every forced dollar gets taxed at a rate that would have been impossible for the same couple filing jointly. That is the crossfire. Trap number 3 is the IRMAA spike. IRMAA stands for Income-Related Monthly Adjustment Amount. It is the Medicare premium surcharge that applies when your modified adjusted gross income crosses certain thresholds. While Dennis was alive, their joint income kept them comfortably under the married IRMAA threshold of around $212,000. They paid the standard Medicare Part B premium of roughly $185 a month. After Dennis dies, Carol is measured against the single filer threshold, which is about half the married number. Her Magi, now including the full RMD and a larger taxable slice of Social Security, pushes her into the first IRMAA bracket. Her Part B premium jumps to around $259 a month. Her Part D plan gets a surcharge on top. The total hit is roughly $900 extra per year, every year, for the rest of her life, for the crime of being widowed. What makes Trap 3 genuinely diabolical is the 2-year look back. Your 2026 income determines your 2028 Medicare premiums. Spike your income this year and you will not feel the Medicare consequence for 24 months. By then, you have forgotten what triggered it. The delay is not a flaw in the design. It is the design. 3 traps. Bracket collapse fires the year the spouse dies. RMD crossfire fires every single January for the rest of the survivor's life. IRMAA spike fires 24 months after every income event that crosses the threshold. They stack, they compound, and they are completely legal. So who designed this? Who decided that the most efficient way to extract additional tax revenue from the American middle class was to wait until one spouse died and change the math on the survivor? The Joint Committee on Taxation has known about the widow's penalty since the 1980s. Brookings has written about it. The American Enterprise Institute has written about it. Congressional researchers have documented it. The information has never been hidden. Every Congress that could have fixed it chose not to, because the widow's penalty generates billions annually in incremental revenue from a population that is grieving, isolated, and statistically unlikely to fight back. I want you to share this video with one married couple you care about right now. Not later today, right now. Pull out your phone, find the share button on this video, and send it to one couple who still has time to do something about what I am about to tell you. One couple, one conversation. That is the difference between a surviving spouse who is financially protected and one who is sitting at a dining room table staring at a letter from an accountant in a house that feels too quiet. Everything I have told you so far is the problem. Now I am going to give you the solution. And the solution is not complicated. It is not exotic. It does not require offshore accounts or aggressive tax shelters or anything that would make a compliance attorney nervous. Every single strategy I am about to walk you through lives inside the standard United States tax code. The escape hatch is inside the same document as the trap. You just have to use it before the trap springs. There are 4 specific asset categories that drive the widow's penalty in almost every American retirement portfolio. If you address these 4 categories while both spouses are alive and filing jointly, you can legally reduce the surviving spouse's tax exposure by 60, 70, even 80% compared to the default outcome. If you do nothing, you get Carol's situation. If you do these 4 things, you get something dramatically different. Asset number 1. The traditional IRA, the traditional 401k, the SEP IRA, or any other pre-tax retirement account. This is the engine of the widow's penalty in almost every case. Every dollar sitting in a traditional retirement account is a dollar of future ordinary income that the IRS has not collected yet. The government is a silent partner in that account. They are letting it grow because when they finally collect, they get to apply their tax rate to a larger number. When the first spouse dies, the survivor inherits the account, and every required minimum distribution that comes out of it for the rest of her life hits the single filer brackets. The fix is Roth conversions. Systematic, planned, multi-year Roth conversions executed while both spouses are alive and married filing jointly. Here is why the married filing jointly window is so powerful for this strategy. The 12% bracket for a married couple in 2026 goes all the way up to nearly $97,000 of taxable income. That is an enormous runway. A couple with $700,000 in a traditional IRA can systematically convert $80,000 to $100,000 per year for 6 or 7 years, paying 12 or 22% on the converted amount, and permanently eliminating the RMD obligation on every dollar they convert. A Roth IRA has no required minimum distributions, ever. The money grows tax-free. Withdrawals are tax-free, and when the first spouse dies, the surviving spouse inherits a Roth IRA that generates zero taxable income, creates zero IRMAA exposure, and requires zero mandatory withdrawals. Run the actual math. If Carol had $710,000 in a traditional IRA and does nothing, she will pull roughly $26,000 to $40,000 a year in RMDs for the rest of her life, all taxed at single filer rates, or potentially triggering IRMAA. Total federal tax over a 20-year survival period is somewhere between $160,000 and $220,000. If instead she and Dennis had converted that account to Roth over 6 years in the married brackets, the total tax paid on the conversion would be roughly similar in dollar amount. But the Roth grows tax-free. The surviving spouse withdraws tax-free. Roth distributions do not count toward modified adjusted gross income, so IRMAA is not triggered. No RMD pointing at the survivor's head every January. No bracket penalty on forced withdrawals. That is the trade. Pay the tax now at 12 or 22% in the married bracket, or let the IRS force it out of the survivor later at 22 or 24% in the single bracket. The widow's experience on the other side of that choice is completely different. Asset number 2, the taxable brokerage account. Most financial advisors get this one backwards. They tell married couples to gift appreciated stock during their lifetime to reduce the estate. For a couple where one spouse may die first, that advice can cost the survivor a fortune. Here is why. Internal Revenue Code Section 1014. The step-up in cost basis at death. When a spouse dies and leaves appreciated assets to the survivor, the cost basis of those assets resets to the fair market value on the date of death. The embedded capital gain is legally forgiven by the federal government. Vaporized. Carol inherits Dennis's index funds with a fresh cost basis equal to what they were worth the day he died. She sells them the next day. Zero capital gains tax. If Dennis and Carol held $195,000 in a brokerage account originally funded with $80,000, there is $115,000 of embedded capital gain. Sell it while both are alive and they owe capital gains tax on $115,000. Dennis dies first and Carol inherits it, the basis resets to $195,000. She sells it, zero tax on the gain. The critical catch is account titling. In a non-community property state like Ohio, if the account is held as joint tenants with rights of survivorship, only 50% of the account gets the step-up in basis. The other 50% keeps the original cost basis. In a community property state like California, Texas, or Arizona, jointly held community property gets a full 100% step-up on both halves. If you are in a non-community property state, work with an estate planning attorney to structure the account in a way that maximizes the step-up. The wrong account title can cost the surviving spouse tens of thousands of dollars in unnecessary capital gains tax, and fixing it costs almost nothing while both spouses are alive. Okay, stop for 1 second. I want to check in with you, because I know this is a lot of information coming at you quickly, and I want to make sure you are actually getting it. So right now, before I give you assets 3 and 4, go down to the comments and tell me which of the first 2 assets applies most directly to your situation. Traditional IRA that needs Roth conversions, or a brokerage account with a lot of embedded capital gain. Just say IRA or brokerage in the comments. It takes 5 seconds. It tells me what content to prioritize in the next video. And it keeps this one in the algorithm, so more couples can find it before the clock runs out on their planning window. Leave that comment right now and then keep watching, because assets 3 and 4 are the ones that most financial advisors never mention at all. Asset number 3, the pension. This one is the silent killer in a lot of retirement plans because the damage is done years before either spouse dies, and most couples do not realize it until it is too late to reverse it. When most employees retire from a job that offers a defined benefit pension, they are given a choice. Option 1, the single life annuity. It pays a higher monthly check for as long as the retiree lives, and then it stops completely when the retiree dies. Option 2, the joint and survivor annuity. It pays a lower monthly check but continues paying a percentage, usually 50, 75, or 100%, to the surviving spouse for the rest of her life. Most people elect the single life option because the monthly check is higher and they do not fully think through the survivor risk. The IRS requires the non-retiring spouse to sign a notarized waiver consenting to the single life election. Most spouses sign without understanding they are waiving their own income protection. If you have already retired and locked in single life, you generally cannot reverse it. That pension income stops when the retiree dies. If you have not yet retired and have a pension coming, elect the joint and survivor option at the highest percentage you can afford. Yes, the monthly check will be smaller, but the survivor income protection is worth more than the monthly differential in almost every scenario, especially when the bracket collapse is already hitting the survivor from every other direction. If you are already retired and locked into single life, you are not completely out of options. There is a strategy called pension maximization. The pensioner takes the higher single life payment, uses a portion of the monthly differential to fund a permanent life insurance policy on the pensioner's life, and when the pensioner dies, the surviving spouse receives a tax-free death benefit under Internal Revenue Code Section 101A. The survivor then uses that death benefit to purchase an immediate annuity or simply invests it to replace the lost pension income. The replacement income from the death benefit is not subject to the bracket collapse. It is not subject to IRMAA. It is not a required minimum distribution. It is simply tax-free money arriving at the moment it is needed most. The pension max strategy has existed for decades. It is not exotic. It just requires a financial advisor who understands the widow's penalty to set it up correctly before the pensioner's health becomes an obstacle to getting underwritten. Asset number 4. The high-yield CDs, the taxable bond portfolio, and the money market accounts. This is the slow leak. Most retirement-age couples have somewhere between $50,000 and $300,000 in CDs, treasuries, money market funds, or taxable bonds. These accounts generate interest income every single year. That interest is fully taxable as ordinary income at the federal level. While both spouses are alive, the interest is absorbed into the wide married filing jointly brackets without much damage. When the first spouse dies, the same interest gets pushed into the narrower single filer brackets and can push the survivor across an IRMAA tier that adds hundreds of dollars per month to her Medicare premiums. There are 3 ways to restructure these accounts before death to eliminate or dramatically reduce this ongoing tax exposure. Option 1 is municipal bonds. Interest from high-quality municipal bonds issued in your home state is exempt from federal income tax under Internal Revenue Code Section 103 and typically exempt from your state income tax as well. For a retiree in the 22% federal bracket, a muni bond yielding 3.5% can have a taxable equivalent yield of 5% or more. You eliminate the ordinary income tax line entirely on that portion of the portfolio. Option 2 is a multi-year guaranteed annuity, and MOIGA. It works like a CD, but the interest does not appear on a 1099 every year. It compounds tax-deferred inside the annuity wrapper. The surviving spouse takes withdrawals strategically in lower income years. Option 3 is cash value life insurance. A properly structured permanent policy accumulates value tax-deferred. Withdrawals up to basis are income tax-free, and the death benefit passes to the surviving spouse income tax-free under Section 101A. For couples in reasonably good health, the insurance wrapper efficiently repositions interest-bearing assets that would otherwise generate taxable ordinary income in the survivor's single filer bracket every year. Which option fits depends on your state, your health, and your liquidity needs, but the point is identical in every case. Taxable interest income in CDs and money markets is a ticking clock for the surviving spouse. Move it while both of you are alive and filing jointly. Now look at what you have if you execute all 4 moves before the first spouse dies. The traditional IRA is converted to Roth in the married brackets. The survivor inherits a tax-free account with no RMDs and no IRMAA exposure. The brokerage is titled correctly for the step-up in basis. The survivor resets the cost basis, sells without capital gains tax. The pension was elected joint and survivor, or replaced with a life insurance death benefit. The survivor has income protection that does not trigger the bracket collapse. The CDs and bonds are repositioned into munis, an MYGA or insurance. The recurring interest is gone from the single filer's taxable income. Carol, instead of a letter that says $68,000, gets a letter that says closer to $9,000. Same assets, same net worth, completely different tax architecture. Over a 20-year survival, that gap is worth more than $1 million. I need you to hear this last part carefully. The planning window is shorter than most couples realize. Roth conversions take 5 to 7 years to execute properly without spiking your own bracket mid-conversion. Pension survivor elections are locked the moment you start drawing. You cannot reverse them. Life insurance underwriting requires both spouses to be in acceptable health. A serious diagnosis and the underwriter closes the door. Account titling and trust restructuring requires both spouses to have legal capacity to sign documents. Wait until one of you is sick and half the tools are already gone. Wait until the diagnosis and you have lost entirely. The IRS has been counting on exactly that. Every default in the American retirement system, the traditional IRA, the joint brokerage account, the single life pension election, the CD ladder at the local credit union, is calibrated for maximum government revenue, not for surviving spouse protection. Tonight, after dinner, sit down with your spouse. Write down 4 things on a piece of paper. What is in your traditional IRA, how your brokerage is titled, what your pension survivor election is, and how much is sitting in CDs or bonds. That is step 1. 20 minutes of your evening. Then find a fee-only fiduciary who understands the widow's penalty, not a broker, not a salesman. Someone who gets paid to give advice, not to move product. Bring the list, run the numbers, build the plan before the window closes on you. The IRS is patient. The IRS is waiting. The system extracts billions from grieving survivors every year because most couples never have this conversation while they still have time to act on it. You just had it. Now go do something with it. Like this video, subscribe, flip the bell, and send it to one married couple you care about before you close the app. One couple, one conversation tonight? That is the only ask. I will see you in the very next one. Stay sharp.